All right, so hello everyone. So today we're going to talk about proper utilization of your SDIC, Specially Designed Insurance Contract. So often we preach to our clients with their financial picture. Part of their plan is using what we call a specially designed insurance contract, right? So once that is built up, we often have opportunities that arise, right, whether it be a business you want to start, whether it be a real estate opportunity, whether it be the stock market dropping 30%,
right?
And we use that.
Correct.
That's a buying opportunity,
right? Well, especially because we work with a lot of entrepreneurs, and one thing we have found, especially with entrepreneurs and business owners, they can usually find ways to get much higher returns than anything that we can recommend.
Exactly.
And if you do what the status quo recommends, they tell you to put all of your money into a 401k or a SEP in the case of a business owner.
Yeah.
Well, the problem is if you want to get access to that money, well, you're locked out, right? Until you're 59 and a half.
And to be clear, we're not saying it's bad.
No, not at all. But when we're talking about specially designed insurance contracts and privatized banking, we have our own stories of ways that we've utilized the money that we've built up in our bank. In my situation, my husband and I, and when I say husband, not Terry.
Yep, not related.
My husband and I were able to open an indoor baseball, softball training facility outside of Austin, Texas. And so that for us was something we saw a need for, something we were really passionate about. We have a son who, college planning 101, right? We're hoping that someday.
My team works out there. I'm in there pitching every so often.
Exactly. We had a natural market. And so we saw that opportunity. And so we decided to take the money, instead of going to a bank and asking for a loan, and where we were subject to the bank's interest rates, the bank's loan terms, we decided instead.
We all know how difficult that can be, going to a bank, applying for a loan. I mean, most of you have applied for a mortgage loan. Well, applying for a personal loan is just as bad.
And it affects your credit, correct?
Exactly.
So the other thing, it's another liability. There's different pros and cons. Well, the pro to taking the money out of our privatized bank was we didn't have to deal with an actual bank. Their terms, everything could be on our terms. And so we decided to start the business with money that we already had, and we were able to set the payback terms. The interest rates were actually favorable in that we were still earning money on the money that we borrowed. So there's a lot of positives to what we did, and a lot of reasons why we went that route as opposed to the traditional. But again, if we hadn't have started the bank to build the bank, we wouldn't have had access to that money.
Personal bank.
Right.
Exactly.
Right.
So yeah, it's a good story. So another way we describe SDIC or specially designed insurance contract is also it's a different place to store your cash, right? So these days you're earning, if you're lucky, maybe 1% at the bank. And that's if you're pretty lucky, right? So with an SDIC, the earnings inside of the cash value that is built up inside there is earning quite a bit more, okay? You made a good point earlier about when you take the money, when you take the money out of your SDIC. So let's say, just real easy example, you have 100K inside of your SDIC. You take 50K out, right? And you're earning, say, 5%, okay? 100K in there, you take 50K out. Well, guess what? The full 100K is still earning that 5%, okay? Not many vehicles can do that, right?
You definitely can't get that from a bank. There's no way you can go to Wells Fargo, Bank of America, Chase, Frost, whatever, and get those kind of terms.
Exactly. So my opportunity came along about 4 years ago. My wife and my sister-in-law was very big into CrossFit, okay? It's pretty popular. I'm sure you know what that is. You've been there before. So a gym became available for sale in our hometown just south of Austin. Okay, so we decided that we wanted to pursue that opportunity and buy this CrossFit gym. We knew CrossFit was popular. Personally, I thought it was stupid at the time, but I knew it was really, really popular. I thought it was a great business opportunity, right?
He's totally bought in since.
Oh yeah, I love it. So we figured out, okay, do we go to the bank, try to get a loan, talk about that process, can be very difficult. Do I use my cash, which my cash is mainly for this business, right?
Sure.
Or do we take a loan from my SDIC, okay? So ultimately we decided we're gonna take a loan from our SDIC, okay? Buy this gym. It took a while for kind of the revenue to get rolling. You know when you buy a business, things have to turn around a little bit.
And there's always unplanned expenses.
Always, right? So once now the gym is profitable, right? So the gym is paying back the loan And I never had any opportunity cost
Correct.
with any of that money. My cash still using for my other business.
Right.
I borrowed money from the SDIC, never even thought about it. Jim's profits are paying back the loan. Now, just like you, just like what I've done, we've created a whole new asset without any opportunity cost from our cash or having to deal with the bank.
Which is huge. And you keep hearing us say the word emergency opportunity, opportunity. Well, that's something that we're going to talk about in one of our other videos about why we call it an emergency opportunity fund, even more so than an SDIC.